Right, moving on. Last video was obviously looking at the UK trade deficit, where we raised the question: is it a good or a bad? Well, is it a bad thing to have such a big deficit on the current account? And what we concluded was, well, at the moment, it doesn't seem to be a massive problem, but it could be if that financial account doesn't keep propping things up. Now, what we're going to think about now then is that if we do regard it as a problem, what can we do about it? Well, let's think about what we can do. There's a few different options available to the government. We could devalue the currency, so we create a devaluation of the currency. Now this is different to depreciation. Depreciation is where supply and demand basically interact to affect the value. With a depreciation, it would be where the value of the pound falls. A devaluation would be where the government actually intervenes to make the pound weaker. Now, think about what that means. The pound became weaker. Let's just take a little simple numerical example. Let's imagine we look at the pound against the US dollar. If the pound fell from being worth $1.50 down to $1.20, then what this would ultimately mean is that imports would become more expensive. In the example above, if we were buying a $1.50 good from America, we used to pay £1. Well, that pound now will not buy us $1.50, it will be 30 cents short. It will therefore raise the price of imports. And the plan will be, what this should do is to lower the demand for imports coming into the economy. And of course, what a devaluation should also do is to make exports cheaper. So the Americans, for example, that used to buy £1 good had to pay $1.50. Now it's at $1.20. Okay, so they now become cheaper, which should raise the demand for our exports. Okay, so if you raise your exports relative to your imports, then ultimately what will happen is your trade deficit will start to fall. But then you've got to sort of question though, is this actually a good way of solving this problem? Well, think about the impact on the economy. There are lots of things that we import from the rest of the world, whether it be sort of natural resources, manufacturing goods, semi-finished goods and services, and it's probably very difficult to make a lot of these things in the UK economy, so you might still have to import them. Now what this will mean is that business cost of production will start to increase. You have this cost push inflation created by higher import prices. Well, that could be really bad for domestic output, it could be really bad for inflation, and it could ultimately cost some people their jobs. But what we would say is that exports will increase as well. So what you should hopefully have as well is a growth in aggregate demand. And as that happens, well, maybe output will actually increase. Maybe jobs will start to grow as well to counteract it, as well, like an export-led growth. But what we will definitely have is lots and lots of inflation in the economy caused by it. So possibly good, but we have got to think about the impact on inflation and what it will do to import prices. You've also got the risk of retaliation. Okay, it's not going to be a popular policy across the world if you do something like this. Foreign nationals that like exporting to our economy are not going to take it laying down, and it could lead to currency wars across the world, and that could ultimately be really, really bad for things like globalization and free trade and things like international relations that we've built up over the years. Many people say as well that it doesn't really get to the underlying problem. If your trade deficit is because you lack competitiveness, well, this isn't really solving the problem. Okay, you've still got problems of poor productivity, and it might give firms just that incentive not to bother investing and rely on the exchange rate to fix all of their woes. Now, other things that you could do, you could just go for a very simple idea, which sounds horrendous at face value, but it's basically to lower domestic demand, deflate aggregate demand. Okay. So this could be done through contractionary fiscal policy, it could be done through contractionary monetary policy, And the simple answer is just make people poorer. Lower demand in the economy. A lot of trade deficit is partly caused by demand being too high. People having this huge thirst for foreign goods and services. Well, if you were to deflate demand across the economy, then ultimately what you're doing is you're stopping people having the ability to buy foreign goods and services. Okay, so domestic demand would start to fall. The only downside to this, though, as well, you could argue, is that it will not only lower demand for foreign goods and services, but it will also lower demand for domestic goods and services. Okay, so it could mean that, not only are people buying less from abroad, they're buying less from UK firms. Well, that could be bad for output, as you can see in the diagram. It could run the risk of deflation in theory, and it could be really bad for people's jobs as well. Okay, many people do say that what it could do is encourage UK firms to look more towards export markets as a way of tackling lower demand. Another option could be protectionism, and we've done a lot of work on this. Just raise those tariff and non-tariff barriers. In other words, stop people from buying the imported goods and services. If we go back to this diagram, domestic supply, domestic demand. Well, if we have free trade, we're there, aren't we? That is what domestic firms are supplying, that's what domestic demand will be. That gap are the imports coming into the economy. Well, if you were to impose tariffs, so price-free trade plus tariff, what you will do, you will lower the demand for inputs coming into the economy. Okay, so it doesn't have to be just tariffs, it could be quotas, it could be even voluntary export restraints of other economies across the board if we can negotiate it. Lots of different ways of protecting our economy. And when you think about it, what this could do, it could give domestic industries that scope to grow and expand. It could allow infant industries to set up and grow. But what we would argue is the downside to this, though, is that it will ultimately be to the detriment of consumers again. It will lower consumer surplus. Will create some revenue for the government. Remember, that will be that area there. It will create some producer surplus for domestic producers, but it will create the overall net loss for the economy, which is those two triangles. You also run the risk as well that other economies will not take to it very well, so it could lead to lots of retaliation happening across the world. One final one, and it's the one that people would push. It's supply side policies. Okay, all this is about making the LRAS curve shift outwards. If your deficit is caused by a lack of productivity and structural problems, then this is the way to tackle the problem head on. Okay, rather than say to people, stop buying that foreign stuff because it's too cheap, it's cracking the British economy, give people a reason to buy British. Okay, now this could actually be through foreign investment, attract infrastructure upgrades, improvements, boost productivity in the UK, push education, improve transport, all the different things which will create, in effect, potential economic growth. Make Britain a cheaper place to do business, a more productive place to do business, raise the quality of British output, and that all happens by making resources either better or to have more resources, basically. Okay, so what you've got then when you think about it, you've got devalue the currency, you've got deflate demand, you've got protectionism. All three of these, though, you have got downsides to them. Supply side, it's the one that looks the best on paper. It's the one that tackles the problem head on, that lack of productivity. But this also creates a problem. This is very much a long-term solution. It's not something that can happen overnight. So if you've got a real short-term current account deficit problem, this is not going to be the answer. So overall, what you've hopefully picked up from this is that trying to solve a trade deficit, it certainly isn't easy, unfortunately.